Welcome back to Radio Rothbard. I'm Ryan McMakin, a senior editor with the Mises Institute. And over the past couple of weeks, Wall Street has become a hot topic because of the so-called GameStop rebellion, in which some small-time regular day traders, among others, managed to throw a monkey wrench into the plans of some hedge funds. This caused both glee and rage among Wall Street observers, depending on which side you were on. But the whole episode really extended the impression, a correct impression, I think, that Wall Street really is something separate from the overall economy. There are those Wall Street guys, and then there's everyone else. So let's talk about Wall Street. To talk about this with me is our associate editor, Tho Bishop. And so, Tho, when I say Wall Street, what does that make you think of?
Well, I think it was Mises that said that one of the hallmarks of a capitalist system is the existence of a publicly traded stock exchange, right, where you could exchange ownership of stock of private productive companies. But of course, Wall Street now is kind of much larger than that. It's more about kind of wealth management, increasingly speculative plays, risk management. Being able to benefit from this environment where wealth is increasingly less grounded in production and servicing customers as much as it is connections to central banking, as much as it's connected to size and scale matter a lot more in the global economy than necessarily the merit of the companies themselves. And, so Wall Street, I think, is, while there's some caricatures and there's a lot of analysis from leftists and some of the populists out there that I think misunderstand, have fallacies within their economic thinking, I think that, the larger perception that Wall Street does not represent the real economy, that it is so disconnected from Main Street, is very genuine. And also its increasing influence over politics and the government, right? And I actually kind of saw this play out firsthand. I was with the Financial Services Committee. That committee started out as a banking committee, which was a relatively minor committee. It was just dealing with, small-time, banking regulations. And now, with this era of financialization, it's grown larger and larger. It's now the Financial Services Committee. It deals with a lot more different things. And again, so that, I think, Wall Street as it exists now is very different than, again, the way that someone like Ludwig von Mises would have seen stock markets, back in kind of the heyday of pre-clown world America.
Yeah, and there are specific institutions we're talking about, I think, that are the quintessential Wall Street institutions. For example, Goldman, right? You got Morgan Stanley. You got GMAC. These are non-bank financial institutions. GMAC, CIT, GE Capital. These sorts of organizations. The lesser-known hedge funds. Right, these aren't just like some average stockbroker necessarily, although they would certainly be involved in what goes on Wall Street. But nowadays, when we're thinking about it, we're talking about some of these big behemoths who always seem to come out on top. They seem to get bailouts. They're very important on the Hill, and they have a lot of both political and economic power. And like you noted, there in Washington, there's a lot of discussion, a lot of importance placed on these committees that handle financial services now. And I think people have lost sight of the fact that these weren't considered to be nearly as important, say, 40 years ago, 1970s, or even into the 80s, because there hadn't yet been this phenomenon called financialization. And this was something that started back in the late 70s, early 80s. And it's like you say, it's this change from an economy that's geared toward the production of actual physical products, but also the delivery of services, real services, just buying an insurance product, for example. Yes, there's a financial element to that, but that's not financialization. What we're talking about here is these institutions that permit a lot of lending, a lot of leverage, these organizations where they allow organizations, persons, people to borrow a lot, to put a lot of money in the hope that they can pay it back later. And there's a lot of betting going on in Wall Street. There's the shorting. There's all of these things that you hear about in these Wall Street focused movies or in the news stories around things like GameStop and so on. And this is different from, say, producing cars or building things or the construction industry and so on. Certainly, financial firms can come into that, but they're not at the core of it. And they were much less at the core of it in earlier periods when people borrowed less, were more likely to pay cash and so on. But this is due to a variety of policy changes. And I did an article on this, just really on financialization, for Mises.org, which looks at a variety of different theories. And the left normally takes theories that financialization, which has shifted all this wealth in the economy toward the financial industry, toward Wall Street, is just a natural outcome of capitalism. But it's really not. They point to things like, hey, look, there's speculative manias, and deregulation has helped Wall Street, and it's all just a product of this late stage capitalism theory and that sort of thing. And certainly manias exist and deregulation exists, but this idea that greed has made Wall Street go bonkers and they're taking over America and it's fueled by just this savage avarice doesn't really make any sense, because greed always has its downside, which is fear that markets will go down. And so the question is, why don't the markets ever seem to go down anymore, right? If you really thought that the financial sector would behave like anything else in the market, there would be ups and downs. There would be fear of losing your shirt in some event, some recession, some financial panic. But over the last 20 years, it seems to not be a whole lot of fear about that. We can just keep pouring money into the financial sector because people figure that's a safe bet. So there's only so much money to go around, at least. You can only print so much, really. And so a lot of that money ends up going to the financial sector rather into the so-called productive sector. So if you're a small businessman who's in producing something that's not related to the financial sector, it's actually harder for you to get capital now because the safe bet is Wall Street. And that's not some natural outcome of capitalism. That comes to us through all of these bailouts and these measures being taken in Washington to actually support the financial industry.
I think it was Matt Taibbi with the Rolling Stone back in 2009 or 2010, when he coined Goldman Sachs as the vampire squid of the economy. And I kind of like that because, I think it's often, you see this on financial Twitter in particular, where people will kind of downplay the significance of low interest rates. It's like, oh, well, sure, you're not getting any money in the bank anymore, but hey, everybody's in the stock market and the numbers keep going up. And therefore, the idea that, small people are getting screwed over by this economy is a complete, myth. And I would love to introduce Joe Weisenthal and some of the people in that orbit to people back home in Panama City, which, they're not the ones that are investing in the stock market and benefiting from some of the bubbles out there. And of course, that's where, again, we're in a very interesting time where there's, some of the critiques by, some of the more intelligent aspects of the left that are less obsessed with the identity stuff, and some of the populist right, where they highlight the dangers of consolidated wealth and corporate power, and the way that it screws over workers and things like that. The problem is, of course, is that their analysis, their answers to this are usually very simple, and miss the underlying substance of it. I think we've talked about in the past, some of the frustration listening to Tucker Carlson on some of this, where he gets so close on hitting on some important topics, but then he'd rather kind of blame libertarians rather than get to like the central bank issue, which is so big here. And that's why I loved your article on financialization that you wrote last year. It's one of the ones that I think I've shared most since it was published, because you going through and explaining, like, well, here's some of the critiques that you often hear, late stage capitalism, whatever that means, or greed, which somehow greed is more prevalent now than it was 40 years ago, 100 years ago, whatever. I never really quite understood that. But breaking down on the unique Austrian sort of insights here, and again its connection, the impact of central banking, and I think that's one of the things that's I think is very encouraging from the Wall Street bet side of things, is that not only did you have people witnessing, and confirming, I think, a lot of skepticism of large-scale institutions in Wall Street and this entire financial game with the changing of the rules and the way Robinhood changed its trading policies there. But now, kind of the pivot to crypto and silver, and them kind of recognizing that the money side of things is where some of the weak points are, and that's something where I think could be very encouraging going forward. Where you have people kind of focusing on that, the real underlying issues with the economy. Safety and Amos with the Bitcoin Standard has been particularly great on this. The amount of people that are waking up on those aspects because of that book. So that's one of the things I think is very interesting about kind of the reaction and this narrative going forward. Because I don't think this rebellion against the suits, to use David Portnoy's expression, is going away anytime soon.
Yeah, the whole they're rich, so they must be bad thing is pretty unsophisticated and lame. And the whole, the manias exist and people are greedy. And it's like the animal spirits of Wall Street, right? This magical thing happened. And so people suddenly started buying all this stuff. And some people got rich and some didn't. I don't really understand it, but the rich guys must be the bad guys and all of that stuff. And so late stage capitalism, just repeat that phrase a bunch, essentially a meaningless term. But it's something they throw out there every time it's pointed out, that there's growing, say, income inequality and so on, but most of which is the product of Fed policy and these bailouts that help Wall Street. It's not built in to capitalism at all. And of course, as you note, even this edifice that they've built to protect themselves is not foolproof, that there are ways to break through, ways to game the system from the other side. But then, of course, they always come back wanting some new regulation that's going to protect them more from any sort of new thing that might happen that might actually cause Wall Street to lose some money. And certainly amongst these that are the biggest factors are just the straight up bailouts that we see. And this is not a new thing. In his book, The Great Deformation, right, Stockman notes that, this wasn't invented in 2008. And of course, many people have noted, boy, we could go back quite a ways, at least to the 1970s. There were some bank bailouts in the early 70s, and Lockheed got bailed out back then, Franklin National Bank. Chrysler then got bailed out, 1979. Bigger deal was the 1984 takeover of Continental Illinois Bank. That was that was a good time to start worrying, right? How often is this sort of thing gonna happen, where Congress basically comes in and just takes over a financial institution to protect the stockholders? And then, of course, there was perhaps the dam broke with the 1994 Mexican peso crisis, and all the right people were opposed to that, right? All the people we would call populists today, both left and right, opposed that because they saw it was just a bailout of investors. It wasn't a bailout of Mexico. And that was then, and Congress never even really passed legislation for that. That was just the executive branch decided, we're just going to pour a few dozen $1 billion into this. And then, but by 1987, you had the Greenspan put, which was basically a type of ongoing bailout. Anytime it looks like Wall Street's going to suffer, we'll just flood the market with more free money and lower the interest rate so that these companies that are looking unprofitable or might lose money on Wall Street, they can essentially become zombie companies. They can just keep borrowing until maybe they do become profitable. So the idea is we can't let anybody go out of business, can't let anybody lose money. But the laser-like focus was on the financial institutions, because these were becoming pretty much the assembly line, the beltway for which we do monetary policy, because we need these financial institutions to help us basically launder money through the sale of government bonds and so on, and to keep all that money flowing. We can't do that through fiscal policy nearly as easily or through companies that actually build physical things. So we'll just rely on the financial sector as our friends, but we got to keep bailing them out in order to do our little plans of monetary policy. And that kind of became the norm. And then by 1998, you had the LTCM bailout after the Russian financial crisis occurred. And then after the dot-com bust, it pretty much became normalized. The Greenspan Fed was just flood the economy with money, blow new bubbles when old bubbles pop, and just keep the money going. And then it just reached a whole new phase in 2008. And then here we are in 2020, 2021, where there's basically no rules anymore. Just print money all the time. And I can see how this worked looking in. I don't know how old timers in Washington maybe viewed this. I mean, was there any resistance to this sort of thing in 2008? I mean, it seems that most members of Congress are totally unsophisticated on this. So it seems that they have completely bought into the idea of, well, you just got to keep the money flowing to Wall Street and that'll save the economy every time.
There were a few people, even 2008, obviously, like the kind of Tea Party revolution, 2010, it became a lot more popular to oppose this sort of stuff because it was the Obama years, and, people are always more favorable of kind of throwing the wrench in the equation when it's the other team in charge. But there were a few Republicans that opposed the bailout. I think Jeb Hensterling, who became Financial Services Committee chairman, he was one of the stronger voices out there that, perhaps doesn't get enough credit for that at the time. But he also kind of had this building of very interesting left-right coalitions. I know Ron's office, Dr. Paul's office, he worked very closely, his staff worked very closely with Alan Grayson, who was this kind of firebrand Democrat down in Florida, where they were able to get in with the Dodd-Frank Act, an audit of the Fed that was limited in scope in terms of time frame, was relative to the direct aftermath of the bailouts. But that was still a fairly significant policy achievement, and actually revealed some very interesting things there. But I think going forward is going to be interesting is what does the next sort of bailout look like? Because now we've created so many bubbles. This, we're having conversations about student loan things, and that's kind of a different aspect, than the larger financial world. But still, like that's an example, obviously, of a bubble there. We have so many people. One of the express purposes of quantitative easing and low interest rates was to push people out of the banking system and into the financial system. Ben Bernanke, like that was one of the goals that he made it very clear. And so now you have a lot of people whose entire savings, their long-term financial future is grounded in a lot of these stocks. And these stocks are, many of these companies are kind of those zombie sort of companies, right? That they're still addicted to debt. They're not turning a profit. Places, their entire business model have changed. I mean, Netflix, for example, it's now a film producing company rather than a technology company. Ultimately, right? I mean, I think Uber has still never been profitable, if my understanding is correct. And so now, the idea that if you start having disruptions, and you have prices, the stock market go down, things like that, and you have so many people in society, again, whose livelihoods are built now on this bubblicious market. The amount of exposure, the amount of the role of the stock market and these financial markets in the daily life of Americans has never been bigger, which now means that you're going to have so much more political pressure in bailing out these companies. They're going to be bailing out everyone next time around. And then I think that's one of the things that it's, I don't know, again, political will, we're effectively living in an MMT world now. I mean, whether or not they use that language or not, I mean, we have now basically accepted that deficits don't matter, that the central banks are there to bail out people. They can always put things on the balance sheet, things like that. That is not going to go away because there's no politically possible alternative to it. And that's why, short of a giant revolutionary change to the underlying process software, right? Like the dollar, losing its place, something systemic in the structure of the economy. I think you're only going to see this moral hazard, this rewarding of size over merit, the proximity of power being more important than the underlying ideas of the company. Is only going to get bigger and create a larger and larger issue that's going to be dealt with eventually, one way or another, going forward in the future.
Yeah, there is an actual economic theory here. It's a shallow one and not a good one, but it's the idea that, yes, if we can keep money pouring into Wall Street, into stocks, this will create a wealth effect. And then people will feel they're wealthy. We can trick people into feeling they're wealthy because they got big portfolios. And then they'll spend money and demand will go up and the economy will go great. And this is the idea. And it sounds reasonable to a lot of people. Now, if you're actually talking to a financial advisor or really looking at where should I put money into stocks, you quickly realize that if you're going to be talking about things like fundamentals and the state of the companies you might be investing in, you sound like you're from 1971 or something. It's incredibly old-fashioned, right? Because who cares about fundamentals anymore? All that really matters is where's the mania? Which stock is the next big thing? As Brendan Brown uses the phrase often on Mises.org, these speculative narratives, right? What's the narrative? Where should I pour my money into now? It has nothing to do with how well are these companies doing. There could be massive layoffs at a company, but the stock's still going up.
Yeah, I mean, I was reading in Bloomberg today. There was an article by Justin Sun, who is the creator of Tron, which is kind of he was kind of held early on as he was a student of Jack Ma, which was very attractive. Obviously, when people that like, oh, China economy great, Jack Ma very smart, therefore protege of Jack Ma, very smart, and he's so in the crypto industry. He's really employed a lot of like marketing gimmicks. And in this article, he talked about it was about him buying a bunch of GameStop stock at the peak, right, and losing money on it. But he's like, basically it was more important to kind of invest in the meme than it was the money. And he talked about the way that he's going to make Tron stand out in the future is that he wants to bring on more celebrities, more social media influencers to kind of make Tron cool and hip and resonate kind of in this meme market. And while I have a lot of appreciation for the power of memes, I question that as a large scale financial strategy for creating a viable financial token. I've owned some Tron in the past. I hope I'd love nothing more than this strategy to pay off. In bubblicious times, there's been crazier concepts that can attract money, perhaps stupid money in the short term. And perhaps that's definitely going to be something I'm going to be watching in that regard. But yeah, I mean, it kind of speaks to the complete lack of foundation, the branding and marketing and the things that don't really have anything to do with the underlying value, the underlying services of the product. There's so much the marketplace that's been warped by this. I mean, I think Peter Thiel has a quote, right, where we were expecting a future where we had flying cars, and instead we got 280 characters. He was kind of mocking the lack of genuine technological innovation we've seen in the economy. And I think that some of this, I think that there's an element where, again, this financial clown world, this financialized world, the draining of resources from genuine market rewards and discipline to what Wall Street is willing to park its assets into and really get on board to. I think there is a genuine real loss of tremendous value and productivity. We always, it's the seen and the unseen, right? We can see the world that we have. What we do not see is all of the innovations and the what the market would have produced without this vampire squid economy that pushed so many resources in these sort of odd and less than great innovative products. And one of the consequences of that is you have people that are big fans like Dave Ramsey and things like that, where it's do not engage in debt, do not have your credit card, be very responsible. And the problem is that these are the very people that are getting screwed by this. You're being rewarded for taking on debt, for making speculative bets, particularly in the last 10 years, where kind of everything went up and you can kind of you didn't need to know what you're doing to kind of make money on it. I know Dr. Holzman, I think he's working on a book. In English, book in English on this topic of inflation culture and the way that it perverts the incentives of the kind of the real economy, and I think that's a real issue. And again, the consequences of it and the way it plays out, these are sort of things where you're reading too much Zero Hedge can make you lose a lot of sleep. So it's one of the things I'll be watching.
Well, and of course, this system then favors people who already have money, right? If you're a high credit risk and you don't have any capital to begin with, you're not going to get access to much money to spend or to invest in your business and so on. This system, thanks to Dodd-Frank and other regulations and just the way the system is built, post-financialization, it's there to favor the big boys, big, safe banks. Small community banks suffer. A farmer who wants to take out a loan who's risky because maybe a hailstorm will ruin his crop or something like that. They have relatively less access to capital. So that's how you see this growing divergence between regular people and people who are real good at playing the game, at playing this, as Stockman would call it, it's a casino, right? No, those cartoony things you note, right? Where I'm going to get actors and memes will provide value to my firm and so on, right? This isn't possible in an actual functioning market. This isn't all an outcome of this game that's being played by the Fed and Wall Street and Washington, where we'll just blow up new bubbles and somehow that'll keep the whole thing going. And it's as you say, if you don't have something to start with, you don't have maybe something to back up an initial loan, you don't have some equity, right? See, if you start out with some equity, you can take out some bigger loans. They'll throw money at you, right? If you got a house in a nice neighborhood or something, they'll throw you $100,000. And then you could use that to invest in some businesses and so on, or maybe speculate a little bit. And if maybe you've got someone who knows how Washington works and he can help you a little bit. And then you can grow your money pretty easily by dumping it in the right part of the casino. But regular people, they don't have that money. They don't have access to it. This whole idea of the wealth effect and we'll pour money into Wall Street, it's a true trickle-down theory in the sense of we'll just pour government money and newly printed Fed funds in at the top with a bunch of rich hedge fund guys who will help us process government debt and send money into the economy through that. But due to, technical term, Kanthian effects, right? It's as you inflate the money supply, it benefits some people more than others. And it ain't benefiting the guy who works at Grease Monkey down the street. It's helping the Wall Street guys or the people who already know money, who have access to hedge funds because they're already rich. And that's the way it works now. It's not there to help regular people. Sure, I mean, the Fed still with a straight face claims that its money printing schemes somehow help regular working class people. But there's even their own data coming out of the New York Fed and stuff shows that the Fed's responsible for this big divergence in income and all this inequality that's been resulting over the last 20 years.
And, it's interesting. I can't remember who it was on Twitter, but I think last year they kind of highlighted how, Wall Street Journal, the New York Times, all these people's a record, very serious people. And you Google Kanthian Effects, there's no mention of this anywhere. This phenomenon, which is, one of the oldest economists in human history, who are highlighting the dangers, the non-neutrality of money creation in the way that, creating a new money, new fiduciary media benefits some people over others. Again, it's a very, very old concept. It's been completely lost in serious conversation about financial markets. And again, I think this is, one of the reasons why I think the work of the Institute, obviously I have an incentive to promote it, but, I think our work stands out here. We've had a lot of scholars, highlight, the role of, the central banks and government impact on, exacerbating this income inequality, wealth inequality. Louis Rouenet is a great young scholar. He's written about it. Carl Friedrich Israel, fantastic scholar over in Germany. He did a lecture on it on Mises U. It's available online. I highly recommend it. Hitting on this topic, and I think this is one of the areas where we have something unique to say on this story. On one of the most, one of the large narratives of, I think, really kind of defining a lot of the political conversations, not just in the U.S., but in a broader sphere. And this is where we must stand on this topic, because it is this central banking system that unjustly rewards certain people and at the expense of others. And of course, it's only been amplified the past year with when we're locking down mom and pop shops. We're pumping in liquidity through the central banks, which again benefit those most closely connected to it. In this reallocation of income. I mean, this is the narrative. This is the most important issue. And again, it's this institution, we have something unique to say on this story, something important to say on this story, and it's something that should appeal beyond any sort of ideological camp. Right? There's no reason anyone on the left or anyone on the right, populist right, Trump right, old school, whatever. This should be something that, unless you have a financial stake in the game, unless you're a genuine benefactor of this crony economy, right? This is something that should appeal to you, and so that's one of the things we're trying to do.
Well, and we're at this system now where it seems everything, whether a policy is good or bad, depends on how does it affect the banks. And this is just a natural outcome to a certain extent of government regulation. I remember an old anecdote about when the airlines were heavily regulated, much more so than now under the Civil Aeronautics Board. And one of these little guys who wanted to start up an airline said that the regulators all had suffered from Panamania, right? That the question was, how does this regulation affect Pan Am? Because Pan Am's the big boy, and so that's what matters. We got to worry about this company and make sure they're okay, depending on what we do with regulation. And so now we've moved way beyond that. Those people who provide just a regular service, those airlines, they're small potatoes now. What really matters is Wall Street. And yeah, how will this affect Morgan Stanley? How will it affect Goldman? That's the question that really matters. And that's that's a pretty messed up state of affairs. And what they really want, you could see this in the reaction to the GameStop thing, was the Congress, the Fed, they're all there really to provide stability and predictability. We need a system that functions well and predictably, and we don't have any of these companies losing a lot of money because then people might go bankrupt and so on. And these are all anti-capitalist arguments. Capitalism means that billionaires lose money sometimes and they go bankrupt, especially when we're talking about these Wall Street guys who don't actually provide a service in the sense that a mainstream or a Main Street firm does, right? These guys, they go completely out of business. They'll be fine. And they're not even lending to regular people now. This whole system's now geared toward the wealthy and creating this wealth effect through the stock market. So it's this banking government alliance that matters. And it's a shame, though, that the populace in America are just picking up on this again after being asleep for really since the 19th century. And I was reminded recently, Lou mentioned in a speech I was watching on this Jacksonian era journalist named William Leggett, who used the phrase, the separation of bank and state, right? You remember this? And this should be our key goal, right? Of course, not just the separation of bank and state, but the separation of Wall Street and state. This should be the rallying call of today's populists. But it seems that maybe they're just not interested in the complicated nature of it, or just the right person hasn't come along after Ron Paul to really demonstrate just how much of a scam it all is.
And that's one of the things I think is really interesting. One of my favorite aspects looking back in American history is the way that the central banking issue largely played a very motivating role in a lot of major political movements. I mean, obviously, Jeffersonian opposition to Hamiltonian policies, Jacksonians war on the bank, the Bourbon Democrats. I mean, a lot of the stuff we kind of touched on in the past episodes, but I think it's something that we shouldn't overlook because, again, this is exactly where a laissez-faire, economically sound message can resonate with a populist approach to politics, within a democracy, a democratic sort of system like we have now. And this is one of our strengths. And it's always I thought was very odd the way that so many libertarians, in DC and elsewhere, never really thought the Fed issue was something that was worth touching on. They'd much rather promote alternative lifestyles than hitting at this issue that really plays into the elite screwing over working class average folks. And there's so much value there, and again, that's one of the things that hopefully we're kind of highlighting with this podcast, and again, there's a lot of material that we produce on this topic, and again, it's one of the things I think is going to be interesting is going forward is how does the Fed deal with is there any attempt to try to are they going to kind of get into the area where they're bailing out everyone? Or are they going to kind of get into this very explicit system of government privilege, right? I mean, that was one of the major issues back in 2008. Was what turned this issue within the housing market and a bubble there into a massive global scale issue had less to do with a big part of it was the differences in the way that they treat Bear Stearns and some of these other companies very early on, right? There was a lack of stability, a lack of consistency in the policy approach, and I think that's another aspect to it that we don't want to lose is that it's not only we're creating those bubbles and all this sort of stuff, but then it's the way that there's so many ways that these government officials and these central bankers can make a bad situation even worse. And this is one of the things I keep kind of pounding up on Twitter and things like that is that, we've always had very bad people in positions of power, but I think we've had dumber people now than we've ever had before. And I firmly believe that. And again, so that tells you everything you need to know about the way that I think these are going to be going in the future. But that's another aspect to it where it's getting, is equal treatment under the law. When does that start breaking away? And I don't know about that. Maybe they will kind of just take treat everyone equally, and by that give everyone free money as much as possible. Approach, but that's going to be, I think, one of the things where the future could be very different than the past, and of course, all this could just leading to creating a larger bubble with the larger consequences down the line. And we'll just see how long the can can be kicked down the line. But again, luckily that'll provide all sorts of fodder for future podcasts.
Right. There's this success in Wall Street increasingly has basically nothing to do with your entrepreneurial skills and everything to do with how good your lobbyists are or how good you are at anticipating which winners Washington will pick next. Well, we better wrap up. I think we've had a good time trashing Wall Street for today. I'm sure we'll come back to it at a future point. But we hope to be back next week with another episode of Radio Rothbard. And until then, have a wonderful week.